when will we start rising? Ashwini Agarwal now joins us. Ashwini, good morning. Thank you for joining. Us. How are you keeping yourself calm, Ashwini, in this kind of a time? Long-term investors are insisting that don't panic. It's time to stay put. But are long-term investors also missing that the shape of the economy is going to change permanently? And as of now, it's very difficult to talk about long-term when everybody is struggling to survive in the short term.
So, the point that most commentators are making, and I will also highlight, is that what comes to rescue at this point in time is asset allocation. If you've had an asset allocation which is appropriate to your age, to your income, and to your savings profile, then sticking with the long term is the right answer to my mind, because in the long run, these kind of events do come once in a decade, but these always pass. So yes, it appears very, very scary right now, but all of us, I have, we've seen 2008 and we've seen 2001 just after 9/11. We've seen the tech bubble. And so on. I started my career when the Harshad Mehta meltdown was in full swing. So when things are down, it just appears very bleak and very dark, and no two events are the same. But what is same is that eventually things do come back, so long as you have the financial ability to ride out the storm, which means no leverage and an appropriate asset allocation.
Ashwini, there are a variety of factors why banks are down. I'm talking about private banks. I'm not getting into technical factors that FI are selling what they own. But one thought is that, look, banks ultimately are a leverage play, and the leverage in the system will reduce, both at the corporate level and also at the retail level. In fact, there is a genuine and I think a very valid concern that there would be retail delinquency, and the problem will start emerging only after 3 to 4 months. So in this kind of a backdrop where we know that credit will get squeezed, leverage will get reduced, what is the right way to look at private banks?
So, Nikunj, it's a very interesting question, because what you say is absolutely right. I mean, the fears of leverage at the retail level, at the MSME level, and how some of that leverage is likely to turn bad is real. We really don't know how bad it will get, because it will depend upon whether the lockdown gets lifted in entirety or in stages on 15th of April. How does the virus data look between now and the middle of April? How quickly do businesses come back? You could paint an optimistic scenario and say that, look, if the lockdown is lifted in most parts of India and by the end of April, labor comes back into factories, then MSMEs will face some stress, but by and large, they should be able to muddle through. You will see a small spike in NPL ratios, maybe in the September quarter or the December quarter, because in any case, the June quarter, you will be covered by the dispensation that the Reserve Bank has given you. But over a period of time, we should be able to work it out. But if this lockdown continues for a lot longer, and if it is much deeper, if the infection rate is much higher, then we don't know. Then, how do you bet on banks which will be the worst hit from the second order and the third order effects of economy going into a tailspin? I also have to add that I am hoping that the government will come out with more fiscal measures to boost demand, to provide relief to the worst affected in those in business as well as those in private employment or self-employed. What we have seen till now as of last week is a relief only for the poorest of the poor, which obviously come first. But I think, at some point in time, I would expect the government to come out with more fiscal measures, especially if the scenario turns out to be worse than the most optimistic case. So we'll have to see how these things come out. What does the government offer? How do the banks take it? If the bank is reasonably well capitalized, if it has a history of selecting its asset quality well, then maybe they'll have the ability to bear the pain and come out of the other end stronger with a better market share. And at some point in time, these stocks will, be worth buying. Maybe if the situation isn't as bad as what the worst that we can imagine right now, maybe they're already good buys. It's very difficult to tell right now.
So then, how does one assess whether it's a time to buy or not? Because ultimately you have to work with an assumption, and frankly, since all assumptions are off, price cannot be decided, Ashwin. We both know that. I mean, I'm hearing this again on a daily basis. Arey, the stock is down 30%, or kitna girega? And I keep on telling our viewers that there is nothing called it cannot fall more, because in a market you cannot predict what is going to happen. Whether it's a 10% fall or 50% fall, nobody knows. At what price you would come and say that, look, whatever the bad news is, whatever the worst case scenario is, markets are pricing it in, and I'm going to buy irrespective of what technically people are telling me, what I'm gathering on the street, and what my fellow fund managers are doing?
I don't think there's a straightforward answer to this question, Nikunj, because we don't know how bad the propagation of the virus will get. We are sitting on a day when we've had a 25% spike in the infection rate over the last 24 hours, which came on the back of another 25 to 30% day. So these rates are alarming. Now, obviously, some of this has had to do with one particular gathering in Delhi, but so one doesn't know how deeply and how far and wide it will spread, or whether these elevated rates will continue. So we'll have to watch the data to decide. So I don't think the price can be the determinant at this point in time. I mean, the way I'm thinking about the market at this point in time is that one has to look at three factors if you want to deploy some cash that is available with you. One is look at companies that are largely dependent upon the Indian economy. The reason I say that is that it's harder to judge what's happening in Europe or the US, and therefore export-oriented businesses are harder to forecast at this point in time, in my opinion, as compared to what we can see and feel in the domestic economy. Second is look at companies that have no leverage or very little leverage, so they have the ability to ride out the storm, even if the storm lasts for 3 months or 6 months. And last but not the least, focus on essentials. Companies that cater to essential products or services, and where demand may not be there today, but it will come back. I mean, whether it's medical services, hospitals, whether it is pharmaceuticals, whether it is consumer products, where some stocks have not fallen, but others have, or whether it is any of these essential services where demand will eventually come back, without fail. And these will be the first things that the consumers will start consuming as things normalize. So non-discretionary and essentials is what I would focus on, with strong balance sheets and an India focus.
Okay. Ashwini, consumers before the crisis were trading at lofty P multiples. If one looks at very logic day-to-day functioning, essentials are still required, and consumer demand may shift from one brand to another, but we are still consuming basic daily essential products, hygiene products, or basic consumer perishable things. So do you think the P multiple for consumer names like a Godrej or a Britannia or an HUL or a Nestle will only expand?
I don't think so. I think that, at least from my perspective, and, I'm wearing my hat of value investing, I would dig deeper. I mean, I'm unfortunately not at the liberty to take names, but there are names within the areas of consumption that you spoke about, where you do have companies that have fallen hard as a result of this crisis. Smaller companies, mid-sized companies, some of them going through their own unique situations, where the prices have come off, where the valuations appear very reasonable to me. And those are the names I would focus on, not necessarily the expensive companies with lofty multiples that you point out. So you can play the same demand via different ways, via different means. I mean, let's take life insurance, for example. I mean, that's another area, which is an essential, where some stocks have taken a solid beating. The business is, I don't think, any worse today than it was a month ago. So, those are the kind of things that I would focus on.
As to how you're looking at the pharma space as well, because this COVID outbreak could be a big opportunity for the Indian pharma sector. And you were talking about how you're betting on some of the essentials. You just spoke about insurance. Where does pharma stand within this space?
Hi, Aisha. So pharma is right up there. I mean, that was the first sector I had mentioned. And, we were quite positive on pharma even well before this COVID-19 event started to play itself out, because these are stocks that have massively underperformed over the last 3 years. In several cases, the franchise value of the domestic business is more than paying for the current market price, with very large export businesses being valued at zero or arguably negative value. So, pharma, I continue to be reasonably positive about. The way I think about pharma is the only risk that we deal with in pharma at this point in time is really a regulatory event. Because these are unpredictable things and can hit any company at any point in time. So the way I think about pharma companies and pharma investing is to hold a bouquet of stocks so that an unanticipated regulatory event doesn't compromise your portfolio returns. Outside of that, I think pharma is a great place to be.
Are you worried about, the prospects of the banking sector, say a deterioration in asset quality if we continue to see this kind of a disruption in economic activity? Do you think that could lead to pressure on capital, on profitability for banks, large or even mid-cap?
Ashadi, I don't know the answer to that, because the answer to that will depend upon how long this lockdown continues, how deep the economy contracts, and frankly, more importantly, it also rests on what route does the government take. See, from a fiscal standpoint, the government has a very, very tough choice to make. It has to choose between the devil and the deep sea. The devil being that you can be fiscally conservative and allow the economy to tailspin into a recession, assuming that, of course, this COVID-19 gets a lot worse and the lockdown doesn't lift in a substantial measure on the 15th of April. The deep sea being that you open the fiscal tap, you prevent a recession from happening, but the currency depreciates rapidly and you risk inflation 9 months or 12 months down the road. So, these are the two broad choices that the government faces at this point in time. I don't know which of these two choices the government will eventually take. I have my opinion. I think that being loose on the fiscal is probably preferable to risking a recession, but that's my view. So the answer to your question on what should one do with the banks, and do I fear rising NPL ratio a few months down the line, and losses and capital adequacy and so on and so forth, I mean, these are valid questions, but the fact is that the answer is not clear to me. Answer is not clear to me because I don't know how big this coronavirus crisis will get, and I don't know what the government's policy response is going to be at this point.
So would you go short in this market, Ashwini? I keep on asking everybody is that, okay, these are great values. It's a 30% fall, 40% fall in individual stocks, which optically prevents you from going short. But if you don't know what the uncertainty is going to be, and now, whether it's a year, it's 2 years, it's 18 months, it could be 24 months in some, in some specific pockets like tourism, hospitality, and travel, what stops anybody from going short in this market? Because if the market has not discovered its value and there is a lot of uncertainty, then maybe money can be made by still going short.
See, Nikunj, you asked me a question which is, beyond my I would say, capability set. I've never shorted professionally. We run a long only portfolio, and I've never sort of seen the short side of a trade. So frankly, I'm not qualified to comment on this. I think from a long side, what is possible, and maybe that has a read through for people who do short selling, is to probably readjust the portfolio where you see a much longer path to recovery to shift more towards essentials. I mean, it's something that is quite obvious, but that's something that one might look at. I don't know whether shorting makes sense at this point in time when stocks have already fallen so much. What if the lockdown lifts on the 15th of April and barring this spike that we've seen over the last 2 days related significantly to one large gathering in Delhi from what I understand, this kind of peters down and it becomes a manageable situation. Bulk of the lockdown is over. By end of April, we find most factories are running at 60-70%. Your shorts will burn you in that environment. So the real answer is that, I again go back to the basics that focus on asset allocation. If you have a lot of cash, put a little bit to work. If you have a well-designed asset allocation program, you should already be underinvested in equity. So it is time to take some money off the table from other asset classes and put it into equities. Obviously not everything at one go, but a small slice, because that's what your asset allocation will force you to do. Within your equity portfolio, look at essentials, look at companies with good balance sheets, look at India-oriented businesses is what I would think.
Ashwini, I'm going to ask something which perhaps could be more like an advice, but when I look at SIPs, when I talk to people, when I look at the Twitter feed, we're getting rather agonizing messages where people who stick to their discipline in a SIP on a 3-year basis, 5-year basis, 10-year basis, the returns are flat to nothing on 10-year SIPs. How does one contain themselves? Because ultimately, if you've not made money, the whole proposition of dollar averaging or SIP investing really takes a challenge. I mean, then we ultimately exposed to a fact that equity is going to be a very, very challenging asset class to be in. I mean, how do we reconcile and comfort somebody who's actually losing money in a 5 or a 10-year long SIP?
No, so, Nikunj, I can understand the pain and, it's very disheartening for a long-term investor. He suddenly finds that all his gains or her gains have evaporated. But the reality is that if you draw a 30-40-year chart, okay, you will have 4-5 of these dips, which are 30% down, 50% down. Okay, they don't last. Now, at any of those points, if you were to measure 10-year compounded average return or 20-year return or 5-year return at any of those lows, it will be negative. But in hindsight, those have been the best times to invest. So when you compare, even for a SIP investor, the compounded annual return at a point where the market has fallen 30% or at a point where the markets have massively sold off, your compounded numbers will look terrible. Now, in January 2018, okay, all your compounded numbers look brilliant. Now, backward-looking numbers will always give you the wrong answer. So you have to look at what is the average number of the compounded annual returns that you saw from that asset class over the last 10 years. I mean, that's the right way to think about it. So you can't look at these numbers at the highs and you can't look at these numbers at the lows, because then you'll want to buy at the high and you'll want to sell at the lows, which is precisely the kind of behavior that an SIP process is designed to discourage. I don't know if I'm making sense, but the way to think about investing is through asset allocation and what are the long-term returns that over a period of time, over a cycle, a particular asset class delivers.
All right, Ashwini, well said, and I think that's what we are also advocating on the channel now, that good news and good prices that rarely comes together. I know it's